This video we are going to discuss budgeting. This is an introduction to budgeting, and our focus will be more specifically on cash budgets. So in grade 10 we focus mostly on understanding basic budgeting concepts. This year we are going to focus on the preparation and presentation of cash budgets, as well as the projected income statement. Next year we will focus on analysis, interpretation and comparison of cash budgets and projected income statements. In grade 10 we introduced various basic budget concepts. This year we will focus, as indicated, on preparing the cash budget and the projected income statement for sole traders. It is very important to highlight the difference between these two types of financial forecasts, namely the cash budgets on the one hand and the projected income statement on the other. So the cash budget is a forecast, in other words a prediction of the cash position of a business over a future period. So this is not about the actual, but what we expect over expected period in the future. The focus is the future. It sets out the expected cash receipts and expected cash payments for the budget period. The projected income statement is used to predict the amount of profit that the business is expected to generate over a future period. It sets out the expected income and expected expenses for the budget period. Thus, the main difference between these two types of financial forecasts lies in the words cash and profit. Cash, we think of the cash budget. It's about the expected future cash receipts and cash payments. Profit, we think of the projected income statement, namely the expected future income and expenses. So first we are going to focus on the cash budget. The cash budget does not rely heavily on your previous accounting knowledge. In fact, preparing a cash budget requires a bit of common sense. You should start by asking yourself the following two simple questions. Firstly, how much money or cash will be received over the budget period, which is a future period? Secondly, how much money or cash will be paid over the budget period? So it's basically the inflows and cash outflows over the budget period. When we then use this information together with the amount of cash on hand at the beginning of the budget period to calculate the amount of cash expected to be on hand at the end of the budget period. As mentioned, when preparing a cash budget, the most important word to remember is cash. The cash budget is an essential tool used in business to monitor and plan the liquidity of the business. By analyzing the cash budget, management can ascertain whether the business will have enough cash to pay its creditors, repay its loans, purchase stock, pay operating expenses, purchase additional fixed assets. If the cash budget predicts a cash shortfall in a specific month, Management can make arrangements with the bank or make alternative plans in advance. So the format of the cash budget. Only the inflow and outflow of cash is predicted and planned for in the cash budget. In other words, only future cash transactions are considered when drawing up the cash budget. The cash budget is divided into the following sections: the cash receipts, a prediction of the cash receipts or inflow for the budget period; cash payments, a prediction of the cash payments or outflow for the budget period; cash surplus or shortfall, the total cash receipts less total cash payments for the budget period. So if the cash receipts, expected cash receipts is more than the expected total cash payments, it will be a surplus. If, however, the total cash receipts are less than the expected total cash payments, it will be a shortfall. The opening balance, the bank balance at the beginning of the budget period, and then the closing balance, the expected bank balance at the end of the budget period. These components may be summarized as follows. So we have the cash receipts. Let's say we receive during the budgeted or expect to receive during the budgeted period 100,000 Rand. We have the cash payments, an expected 70,000 outflow, that's why it's in brackets. We get the difference. In this case, since the receipts is more than the cash payments, it will be a cash surplus. If the cash payments were more than the cash receipts, it would be in brackets a shortfall. Let's assume we had an opening balance of actual money in the bank of 10,000. So now what we actually had plus what we expect in terms of the surplus together will give us our closing expected bank balance of 40,000. So a cash surplus, an increase in cash, arises when the expected cash receipts are greater than the expected cash payments for the budget period, as was the case in this example. A cash shortfall, decrease in cash, arises when the expected cash receipts are less than the expected cash payments for the budget period. So that will result in a negative amount as the outflows is more than the inflows, which will therefore be a shortfall. Following is a list of some of the more common business transactions that need to be considered when preparing a cash budget. So first let's look at the cash receipts or the inflow of cash. Cash sales, obviously. Note, not credit sales. It's the cash sales. Receipts, though, from debtors. So we can sell on credit, but then we expect our creditors, or rather our debtors, to pay us back what they owe us. It's those receipts, expected receipts, that we enter into our cash flow statement. Investment income, like the interest that we receive on a bank account or investments, the rent income received from tenants, disposal of fixed assets if we sell it for cash, a loan that we receive from maybe a financial institution, investments that mature, in other words, we invested the amount and now we are receiving it back. Cash payments or the outflow of cash, the cash purchases of stock, not credit purchases of stock, only cash payments of stock. But then when we buy on credit, at a stage we will pay our creditors back. Those payments to creditors will be an outflow of cash. Operating expenses paid, for example, insurance, cash drawings by the owner, cash purchases of fixed assets, repayment of loans to financial institutions, investments like fixed deposits. So all the types of transactions listed above are cash transactions. Transactions such as bad debts, depreciation, discount received, and drawings of stock are not cash transactions and are therefore not included in the cash budget. I repeat, transactions such as bad debts, depreciation, there are only book entries, no cash flows or associated with them. Same for discount receive and drawings of stock.